Okay, folks, welcome back. This is the last volume, volume 3 of Mastering High Probability Scalping. And this is dealing specifically with previous day bank liquidity runs. All right, for some of you, this is going to be a little bit of a rehash, but it's necessary, so it is what it is. Whenever I refer to Power 3, what I'm referring to is the three components that make up generic price action. That's the accumulation phase, where long or short positions are accumulated. Then a manipulation stage where price goes the opposite direction to what the intended future direction will actually be. And then there's a range expansion, and then a distribution. The way we use this concept is when the daily bias is bullish, we're going to be confirming the London session was in fact bullish. That means that we see a measure of bullishness after an attempt to go lower was rejected and price has seen a rally. This would be enough for me, coupled with the daily bias being bullish. Then you simply wait until 7 a.m. New York time to stalk your long entry. Between 7 a.m. and 9 a.m. New York time, typically the setup will form. After 7 a.m. New York time, you're going to be waiting for a price retracement lower. New York session will retrace typically from a swing high intraday that was formed for the daily high or a short-term high during the London session. Ideally, you want to be selecting retracements of at least 20 pips or lower. If no retracement of 20 pips forms by 9 a.m., walk. That means cut bait, don't try to take any trades. If you are exceedingly bullish, if you see a retracement of 10 to 15 pips, sometimes this is enough during this key time of day for an optimal trade entry long. If it does form, enter on the 62% retracement fib as it drops lower. Expect price to retest the high of the day or the previous day's high, and then look for targets 1, 2, and symmetrical price swing on the fib. As you can see, here's an example, and I have a vertical line here. This is delineating 7 o'clock in the morning New York time, or the beginning of the New York session. And price creates a bounce in the pre-New York session, but it's an exceedingly large retracement, and I'll talk more about that when we mention how to time or anticipate reversals. But after 7 a.m., which is that vertical line, we have a retracement of 20 pips. Actually, it's a little bit more than 20 pips here, but this is a really good setup. The price trades down into the optimal trade entry, and a beautiful market run. Now looking at Power 3, again, we're looking at the accumulation phase. In this case, it would be the accumulation of short positions. Then a manipulation phase where price runs up higher during London, knocking out individuals that would already be short and putting those individuals on the wrong side trying to go long. And then a nice move lower. If we see this occurring while at the same time the daily bias is bearish, this is good. And again, to confirm the London session being bearish, we want to see price move above the opening price at midnight New York time. If that occurs and price rejects that and goes lower and trades 25 to 30 pips lower, at least minimum, for the London session, that would indicate at least the expectation that New York session should present a continuation idea or bearishness. Now, obviously, you want a little bit more movement beyond 30 pips or so for the London session, but nonetheless, you want to see that if you're staying up and you don't want to trade London. I'm teaching primarily the New York session for the scalping model. But if you see the reasons that would justify a bearish London session, that means, again, primarily with an open at midnight New York time, an attempt to rally and rejecting that and trading significantly off that. Now, again, what's significant? 30 pips or more. And going into the New York session, I would anticipate the following criteria. We're going to be waiting for 7 a.m. New York time to stalk our short position. Between 7 a.m. and 9 a.m. New York time, it usually will form. After 7 a.m. New York time, we're going to be waiting for a retracement. New York session will typically retrace from a swing low. Now, what's swing low? The swing low that was formed in the London decline. The initial decline, once it starts to retrace, we're going to be looking for a price to move higher. Ideally, we're going to be selecting retracements of at least 20 pips or more as it retraces higher. If no retracement of 20 pips forms by 9 a.m., we're going to be cutting bait or basically walking, and we'll be looking for another opportunity the following day. If it does form, we're looking to enter at the 62% retracement level as it rallies up. Again, important that we want to be selling short as price goes higher. We'll be anticipating and expecting price to retest the low of the day or the previous day's low, and or targets 1, 2, and eventually symmetrical price swing on the fib. Okay, here's an example here. And again, the vertical line delineates the 7 a.m. marker for the New York session. So immediately after that, we're going to be on watch for a retracement higher of at least 20 pips. Now, again, if you're having very strong convictions about the market being very bearish, you can anticipate a optimal trade entry form at 15 pips or so. You can get real aggressive if you're on a 5-minute chart and take 10 pip retracements if you're extremely bearish, but that's going to be for folks that have done this for a while and has developed a measurable amount of experience. I guess I'm looking for the word that would best suit it, but experience is going to dictate that. But to avoid the false setups, it's better to wait for at least the 20 pips move higher, in this case for a short for optimal trade entry. But the key is waiting for a 20 pip rally after 7 a.m. New York time while the New York session is anticipating a continuation lower of what was seen in London. So in other words, if we're looking for bearishness to continue from a weak sell-off in overnight trading in London, we'll be looking for a retracement after 7 a.m. New York time to get a short-term overbought condition, and that's going to be capitalized on by an optimal trade entry short, trading short at 62% retracement level, and then looking for the intraday low that was formed to be retested and or the previous day's low. And then after that, we would be looking for, again, targets 1, 2, and symmetrical price swing on the fib. Now, if you don't know what those levels are on your fib and you're watching this video for the first time and have never seen any of my other work, if you go and look at my YouTube channel, Inner Circle Trader, it will obviously show you a optimal trade entry primer, and I'll show you how in that video how to set your Fibonacci up so you can see the levels I'm referring to. Okay, when to expect reversals? When the hourly or 60-minute chart trades to an obvious old high or old low that has shown a clear willingness to reverse price before in the past, okay? When it's obviously seen a reaction that pushes price the opposite direction once it's been traded to it, this is most likely going to repeat itself. Now, sometimes price will not respect an old high or low, and these generic support and resistance levels will give way, and we never really know for sure. So I know what you're going to ask me is, how do I know if the old low or high is going to hold price and cause it to reject and go lower or higher? And the answer to that question is, I don't know that. Think about that. It's probably unsettling, I know. I know some of you want to have that answer, and I wasted years believing I would find it. And I found out you don't need to know that. Sometimes you're going to mess up, sometimes it's going to be wrong, and sometimes you're going to get stopped out. And it is what it is. You cannot escape it. You're going to lose money. You're going to lose on trades, and there's no reason to worry about it. Now, it's far better to expect them to cause a reaction than not to. Why? Because there's plenty of moves and price swings between these key time frames and higher time frame price points that you shouldn't have to worry about it. So there's a plethora of setups that will be forming between these 60-minute reversal points or old highs and old lows to not have to worry about it. So here's a little bit of logic for you. If you knew you're about to take a trade and it's going to quickly encounter one of these reference points on a 60-minute chart, an old high and old low, where it's shown classic support and resistance characteristics, maybe that's a trade you don't want to take. Or if you're going to do it, be very, very nimble about where you're getting out at. Don't anticipate a run through that low or that old high. In this example here, and this is real world examples, I've done this actual trade based on what I'm showing you here this week at the time of this recording. So those individuals that follow me on Twitter, they know exactly what I'm talking about, and you can go look at my Twitter and you'll see it for November 10th, 2017. So we have a old low on the hourly chart here for British Pound USD, and as price trades back down to it, we would anticipate a measurable bounce or potential reversal. So that means we don't really want to be selling short around that time because it may encounter some measure of bullishness, or at least an unwillingness to go lower. So if we use the logic that we may anticipate a rally higher, we can look for optimal trade entry longs in a New York session on a reversal basis, not a continuation of what has been seen overnight in London. So eventually, if we see that 60-minute chart move higher and break a market structure as we've seen here, then we can look for the following day to do a standard classic buy day, which you'll learn about in my tutorials. And the market trades down, gives an optimal trade entry long at the London Open. And like myself here, I was only 7 pips away, 4 pips if you're using the spread from the very low of the day, calling about an 80 pip move or so intraday. And very, very nice run as a result of it. But the 60-minute chart is going to help you ferret and filter when the market most likely will reverse. Okay, money management. While you develop and practice in your demo account, it's important for you to implement strict risk controls. Now, I know this isn't fun, it doesn't sound fascinating, it's not sexy, but it really is your only protection. And in this business, you need everything you can to protect yourself, many times from yourself. And if you want to see what can be accomplished, you need to use sound money management. Now, for this and many of my teachings, you're going to see me preaching, consider 1% per setup. That means 1% of your total account equity, and gradually working your way up to 2% if this meets your risk tolerance. Now, I'm not trying to talk you into these percentages. Many times, some of you will actually elect to go with less than 1%, and there's nothing wrong with that. Some of you want to be cowboys and want to trade larger than 2%, but my advice is if you've not been profitable for at least 5 years minimum, I wouldn't even venture above 2%. It's just not worth it. Now, it's important not to try to swing for home runs or take larger risks to try to grow your account faster. It's not necessary, it's reckless, and you shouldn't try to do it at all. Over leverage will impede your development and drastically decrease your chances of seeing responsible equity growth as well. So if you look at a set as we have here, and this is again, it's a setup I actually took today in the market on November 10th, 2017 in the British Pound USD. The London setup I used, and this is London setup, so not really teaching the application in a New York setup, but it's the same principle. If we are looking for an optimal trade entry long, and let's assume for a moment we are trying to buy at 131.20, our stop loss relative to the optimal trade entry pattern and fib would be at 131 big figure. So we have a 20 pip range between entry to stop loss. From a risk base, if we had an account of, say, $1,000, a very modest account, and having 1% of that, our risk in dollar terms would be a total of $10, less commission and whatever it is that you would be paying for your broker. Now that $10 with 20 pips, you divide that $10 by 20 pips and it gives you a multiple, or in this case your demo leverage would be 5 micro lots, okay, or about 50 cents per pip. By having this, we know that we should not see a larger loss than 1% or $10. If we took the loss, our account would drop down to $990, give or take whatever commissions your broker may or may not charge. If we're trying to trade with this model, okay, obviously you've seen many instances where I've shown how taking partial profits can remove that, number one, barrier of being able to hold on to the trade because you want to make a profit. You're afraid to take a loss and you want to make money. By taking partial profits, and in this case it'd be at 131.54 would be our first profit objective. By taking something off, it removes that insatiable desire to be right. You've taken something off, you've reduced risk, but you also gave yourself that little cookie, that little pat on the back, you did something good. And at this moment, you can choose to do that, or if it trades up to target 1 on your fib, that would be in this case 131.69. At that moment, then you can move your stop loss to break even and take no partial, and then try to reach for target 2. And at that point, take a portion of the trade off and then move the stop loss just below 131.54, or where would your top of your fib would be, where you've anchored it on the high point. You can move your stop loss just below that, and then again consider taking partial profits at the symmetrical price swing and maybe leave a little piece on to go further, or collapse it entirely at the symmetrical price swing. The effects of money management and the rules I've never been, I guess, so rigid in the way I do it. I trade more or less with an impulse, with what I feel the market's telling me, and it's hard to digest that, and it's all based on tape reading. And tape reading is, that's an experiential thing. It's you can't really teach it. You can't say here's what you do. It's something you have to learn by spending years, not days, not a couple hours, not a couple months, years of watching price action. I've said it many times now, and I'm a dinosaur. I'm over 25 years doing this now. So there's a lot of experience and things I've seen that tend to repeat themselves over and over and over again in price. And I'm very rarely ever shocked or surprised by what I see in price, because it's usually the same type of thing over and over again. But you would think with 25 years plus doing it, I would have a rigid exit strategy. And the closest thing I've got is using these fibs and what I feel from the marketplace. Now, some of you will take this insight that I've shared with you and build a really strong, rigid, rule-based idea about when you take profits. And I've actually asked my own mentorship students if they are able to come up with something. I would love to be able to see that, because I have always been very honest and said that my weakest point in my trading is the exits. I'm never satisfied with them, because I'm trying to crack that. As like entries, I got like dialed in. I know what I'm looking for, but exits, I'm always looking for a way to improve that, because think about it, that's how we get paid. So there's no real hard and fast rule-based routine that I do that I always follow. It does, how much do I take off if I have 10 lots on? How many lots do I take off at first scale out. How many do I take at target 1? There's many times where I won't take anything off at first profit. I'll wait for target 1, and I'll take half off there. And I'll take another portion off at target 2, and I'll have something on for symmetrical price swing. And then if there's time left in the day, I'll leave another portion on for that. So it's all a matter of what I see and feel in the marketplace. And I know that probably doesn't satisfy some of you. You're going to assume and almost feel like you're in a position where you can demand that I tell you exactly what I'm doing all the time. And this is one of those instances I just can't do that. I don't think there's really a set in stone process that would be so beneficial for you that if you do it this way all the time, it's good enough. I have not seen that in my own experience. So taking profits, I think, is something that's personal. You need to know what you're going to do, and you're going to spend the rest of your life, mastering that and never arriving at mastery. So that's going to be it for this volume. I've covered a really good approach to breaking down how to find the setups. The currency pair that you're probably following, if you're just looking at one, it's not going to give you a setup every single day. But if you have a nice handful of pairs that you're looking for specific conditions as we outlined, it will give you a setup a couple times a week, and that's all you need. You only need 23 pips a week at 2% risk, and you can double your account every single calendar year by compounding 6% return. 6% a month is not a lot. It's very easy to get to, but you have to know what you're looking for first. And hopefully in these 3 volumes in this series, it's been short enough and concise enough for you to at least see what it is that I can point to on a chart, and you can see it too, and how it repeats itself. There's consistency, there's continuity, there is high probability, and it except for the rule-based ideas that's lacking on the exits, because it's more or less, you're going to be winging it, okay? And I wish I could be stronger in my approach to teaching that, but there's just really no way for me to formulate always this is the way it's done. I got levels I like, and based on what I see in market action and time of day, because of my experience, that'll tell me what I want to do. And it won't always be the best way of doing it. Sometimes it just takes off and goes on and on and on, and I won't be a part of that move. Or sometimes I'm holding for something like that, and it doesn't really run. It just goes to target 1, or maybe it goes up to first profit, and I didn't take anything off there, and it comes back and hits me on my stop. So there's things that you're going to have to learn by experience, and I can't teach it to you. No one else is going to be able to teach it to you either. And you're just going to have to accept that. There's going to be things that you're not going to get answers to in trading, that you'll find the closest thing to answering it by your own discovery. And be excited about that. You don't think that you have to know everything right now, because you don't. Because there's a lot of things that you're doing or about to do, or the way you think, that's going to be the impediment on you becoming consistent or profitable at all. The person you sit and stare at in the mirror, that person is your biggest enemy right now, because they're telling you all the good things, and they're trying to tell you not to talk to yourself when you're doing it wrong. Okay, your conscience needs to be. You need to be sensitive to your conscience. Okay, if you know what you're doing is wrong, even in a demo account, you need to stop and just get yourself out of the marketplace. If you're not going to be focused and organized, don't bother with it. Okay, but hopefully you've seen enough with these 3 videos that I've given you a way to go into the markets every single trading day and look for opportunities. Even if it's in hindsight, it's beneficial to study it. But there's something that is specific that now you can go into price action and now seek it. So many folks, when they first start, they put all these indicators on their chart and all these things, okay, to distract themselves away from the open, high, low, and close. And the open, high, low, and close is the 4 best indicators you're ever going to find in price action. It's price. So hopefully you found this insightful. Hopefully you enjoyed it. I'd love to have your feedback on Twitter at IMICT. And until next time, I wish you good luck and good trading.